Hello, everybody. Today, I want to place before you a few principles by the legendary Jack Bogle. Now, before we discuss the principle itself, let's understand who Jack Bogle is. Jack Bogle is a legendary investor and fund manager who is famous all over the world for his low cost index funds. I am personally a huge fan of Jack, and I have been following him for a very long time. He is the founder of the Vanguard Group. Vanguard is the world's largest mutual fund provider with over 6 trillion US dollars under management. He is known for his role in promoting the concept of index funds. If you'd like to know more about index funds, please watch my other video for which I have provided a link in the description. I personally love Jack Bogle for the way he has simplified the principles of investment for the common person. In the next few minutes, I will discuss a few of his principles. Now, let's get into the principles itself. The first one is time is your friend. There is nothing, and I mean nothing, that has a bigger impact on your investment journey as time. It is so important to start as early as possible, which is why the message is so important early in life. I would request you to please share this video with youngsters in your circle. The earlier you start, the higher is your success in your investment journey. Time also refers to how long you stay invested. Compounding is real magic. One needs to stay invested to experience the true impact of compounding. Please watch my video on this subject. The link is given in the description. The second principle is buy right and hold tight. Doing good research and investing in good companies is very, very important. Spend as much time as possible to study companies before you decide to invest. Moreover, and more importantly, stop taking tips from random people. This is known to cause the biggest investment risk. Do your own research, check multiple resources, stop taking tips from the uncle next door. The next principle is to have realistic expectations. A lot of times our investment decisions are plagued by unrealistic expectations. Everybody wants to become rich overnight. This itself leads us to taking silly decisions based on tips from some random people. Now, what is a realistic expectation? As long as you are beating inflation by say 5 to 6%, you will ensure that you continue to build wealth over time. Now, if you can do a slightly better return, so be it. But don't get drawn by these crazy returns which sometimes lead us to take poor decisions. There is no perfect definition of realistic expectations, and this itself will change over the years. But unrealistic expectations can lead you down into a mess. The other important principle is forget the needle, buy the haystack. Now, what does this mean? What did Jack Bogle mean when he said that? What this means is, unless you're an extremely good stock picker, don't try to be a stock picker. Again, there is no perfect answer, and it all depends on how good you are. But for most common people, for the more common investor, Jack recommends that they use the route of mutual funds, and within mutual funds, a broad index fund. There is risk in every approach, but investing across broader funds takes away the need or the risk of being a stock picker. The last, but probably the most important one, is you cannot escape risk. There is a perception that fixed deposits with banks are risk-free as compared to, say, investing in the stock market. And that is partly right. An FD gives you some protection of your capital. But unfortunately, while you hold on to your capital, inflation will eat into the value of the capital itself. Remember that the bank FD will provide interest that is close to or slightly higher than inflation itself. This itself is a big risk. Now, in summary, let's once again look at the key principles. First one, time is your friend. Start early. The earlier you start, the better it is. Moreover, you need to remain invested for a long time for the power of compounding to kick in. Buy right and hold tight. What does this mean? Buy good quality stocks. Don't buy any random stock just because someone in your neighborhood mentioned it, and sit on it. Constant buying and selling will slow down your growth. Next is have realistic expectations. Having unrealistic expectations can make you take silly decisions. Inflation plus say 5 or 6% should be a good reasonable return. If you can do better, it's fine, but don't take undue risk. Forget the needle, buy the haystack. Invest via broader mutual funds. And low cost index funds are probably a good place to start. Last but not the least, you can't escape risk. All investing has some level of risk. What matters is the returns are well over inflation. Investing in bank FDs can mean capital losing value over a period of time. I hope these few principles will help you in improving your investment decisions and lead you to a better investment journey. Thank you, guys.